This is the Clear Money Talk podcast, offering up creative solutions for your retirement future through education, choice, transparency, and empathy. Now, your host, CEO and founder of Clear Financial Partners, Tim Clairmont, and co-host, Tyler Andrews.
Hello. Welcome to Clear Money Talk. My name is Tim Clairmont. I'm the CEO and founder of Clear Financial Partners, and your host today, along with your co-host today, Tyler Andrews.
Thank you, Tim. Another day, another podcast.
Yes.
I'm excited to be here. It's always fun.
Another day,
it's always
another
fun.
Podcast. That's I'm sure that one's going to get requoted over and over.
I'm gonna get that tattoo.
Really solid.
Another day, another podcast.
Another day, another podcast. All right.
Yeah.
So as always, welcome to Clear Money Talk. You, as the audience listener or viewer, if you're on YouTube, get a chance to know what the question is before I do. I have no idea what the question is. So we will find out what the question is and then pick my brain and Tyler's brain on the best ways to address answering this question. So what's our question of the day?
Question of the day: are target date funds helping or hurting your retirement plan?
Ooh, that's a cool one.
That's a cool one.
Yeah.
Yeah. Good old generative AI came up with that, and I said, I like that one.
All right.
We're going to roll with it.
No, that's actually, it's really solid. So are target date funds helping or hurting your retirement plan? Of course, like so many of the answers, the answer can be both. It just depends on your circumstances. But let's talk about that because, your circumstances ultimately will dictate whether target funds are likely to be extremely helpful for you or whether they may be actually, hurting you in your situation. So I guess my gut, Tyler, I know a lot of times you have advanced bullets prepared that you're thinking about that we're going to go into. But, in general, as I think about target date funds, I think they're a great easy button option for people that are just getting started, that want a diversified portfolio with a relatively small contribution that they're getting going with. And it is the easy button if they pick a time frame that's consistent with their retirement, which is, especially if they're younger and they have a lot of time before they're planning on retiring. I think those are probably where it's the best case scenario for target date funds helping. And then the worst case scenario is when you have that same young person choose a target date fund that's wrong, like anticipating their retirement as if they were going to be 25 or 30 and they're 20 years old doing it, and then they're going to be in a very, very conservative allocation without realizing necessarily how conservative they might be. That might be appropriate from a risk tolerance standpoint if that's intentional, or maybe a market timing issue if they're thinking of trying to be out of the market or be more conservative for a short period of time. But generally speaking, most people that are investing in target date funds are not really sophisticated in terms of their approach. If they get more sophisticated as an investor, they're usually picking their own positions. And so assuming that you're just looking for an easy button option and you just don't want to mess up when you push it, that's important for a young investor. But we'll talk also about older investors that are closer to retirement and the implications associated with those target date funds when they're close to retirement or even in retirement. They've still got that money in those target date funds. And they're possibly in their 60s and already retired, and they've left them in target date funds, and that generally is I would say majority of the time not going to be helping them and probably is hurting them. So maybe we can explore a little bit of that too.
I love it. I think that's a great.
Yeah. What do you think?
Great starting point. No,
okay,
that's good. I think. I have a feeling a lot of our listeners already know what a target date fund is, but I also hope we have maybe some new listeners that don't know what a target date fund is. I think it's a good idea to explain what the target date fund is really quickly, and then it can give us a more broadly exposed idea of everything else we'll go into detail on.
Great
So,
call.
Do
you want to explain it?
Sure.
Yeah, go for it. Explain
Very
what a target date
simplistic
fund is.
terms, a target date fund is a type of mutual fund. Most of the times are qualified employer retirement plans like your 401ks, your 403bs, 457 plans, all the 401as, all those plans that are offered by your employer, or if you're an employer, you may be offering them to your employees, use mutual funds as the investment options inside the plan. And some of those mutual fund investment options are what are called target date funds. And they're basically set up pretty similarly to how they sound, where you choose a predefined retirement date, let's just say 2040 in this example, where you want to retire in the year 2040, and that mutual fund will automatically shift the asset allocation over time as you get closer to that, and get more conservative as you get closer to that quote unquote target retirement date. As you typically get closer to accessing money or needing money if you're retiring, usually people want to get more conservative and take some of the risk off the table by getting more conservative. So the mutual fund does the hard work for you, and it automatically shifts your asset allocation as you get closer to that goal. So that's really it in a nutshell.
Yeah, no,
it's a simplistic way to say, hey, I want to invest in my employer plan. I don't want to micromanage the nuts and bolts of choosing my own individual funds. I want somebody else to do that knows more about it than me. And choosing a target date fund will automatically shift your asset allocation in a very general format as you get closer to whatever target date you choose.
Mm-hmm. Yeah, no, I think that's good. The only thing I would add to that in terms of explanation is the typical time frame that we see on target date funds breaks out in usually 5-year segments. So usually end up with something like a 2025 fund, which would be assuming you're retiring right now, a 2030 fund, 2035, and so on, all the way up to like maybe 2070. And if you're theoretically, just do some quick math with you, if you're 40 years old today and you're thinking you're going to retire at 65, that would be 25 years out. So you might theoretically choose a target date fund of the 2050 fund, because that would be 25 years out. That's the idea behind it. And then as you get older, if you get into your, let's say 55, you're within 10 years of retirement at 65, that same 2050 fund in 2040 would likely be more conservatively invested, as Tyler articulated, than it is today, when they know that you have 25 years ahead of you versus 10 years ahead of you, as an example. I think it's a great explanation of what these target date funds are. So now that we understand what they are and what they do, the crux of whether they're helping you or whether they're hurting you really comes down to two things. They're helping you if you have a very small contribution and you want a very diversified portfolio, because you can get a pretty diversified portfolio with a target date fund without having to think a lot about the mix. And you might end up with, if you pick something like a 2070 fund, for example, and you're 25, 30 years old, you're probably looking at almost 100% stock allocation, which is pretty similar to what you would likely choose on your own anyway, with that kind of a time frame. And yet, with maybe even as little as $50 or $100 or $200 a month, you could be diversified amongst dozens of sub funds within that target date fund, and each one of those sub funds might have 1,000 stocks in it. You could literally have thousands and thousands of different positions in different companies with just a couple $100 a month, which is pretty cool from a diversification standpoint if you want to be diversified like that. On the other hand, the biggest disadvantage of a target date fund, I'd say, if you're 70 years old and you're retired already 5-10 years ago, and you're in a target date fund that was maybe, let's say, a 2020 target date fund right now, and it's 2025, and here you are 5 years past that date, there's a good chance that they're invested more conservatively than you would otherwise choose. And when you're building your wealth in the accumulation years, your strategy you should use is very different than the strategy you should use in your distribution years. So when you transition into distribution, I think it's very, very important to reconsider your target date fund allocation. If you're still using it in retirement, you probably are very outdated in that respect. You could suffer from sequence of return risk and the implications of that. You may also end up being way more conservative than you would intend to be. There are a lot of studies out there that have indicated the optimal retirement allocation over a typical 30-year retirement experience is probably somewhere around 75% stock, 25% bond. And if you're potentially 50-50 or maybe even 60% bond, 40% stock, that could be a more conservative allocation than you intend to be over a 20, 30, 40-year retirement experience. And the target date fund may end up with an allocation like that if you're not being a little more intentional about how it's invested. So I guess that's where I'm at mentally on that. How do I want to break out the bullets?
No, I think you hit on some good points. There's a certain aspect of there's an illusion of set it and forget it, and the target date funds set that up for investors of let me just set it and forget it, and I feel like that's an illusion that can't be overlooked. Many investors think target date funds are very custom tailored to them, and it's not. It's a one size fits all solution for any investor that chooses that fund. And for you, that might not make sense. It might have a different basket of stocks versus bonds than you want for your risk tolerance, time horizon, tax needs, and all that other aspects. It might have a different basket of investments based on domestic companies versus international companies than otherwise what you would want for your allocation. And I think all those factors are worth knowing, mentioning, giving consideration to, and just knowing that there's more than just setting it and forgetting it with these
Yeah.
target date funds.
I appreciate that you brought up the tax consequences because that actually is a significant element in non-retirement accounts. I always think of target date funds in your 401k or your IRA or your Roth IRA accounts. And, in those scenarios, you don't really worry as much about the tax implications because at least the investment doesn't control the tax implications as much as the type of account controls the tax implications in qualified retirement plan accounts. But in non-qualified accounts, just like normal investment brokerage accounts, if you choose a target date fund, you're likely to experience distributions that could be short-term capital gains, dividends. If you end up with short-term capital gains and dividends, those could be taxed as ordinary income taxes, much less favorable than potentially long-term capital gains. So having some intentionality around tax management of your portfolio in non-retirement accounts is very important, especially the larger the balance is. And a target retirement fund or target date retirement fund in a non-qualified account would likely generate more tax implications than alternative strategies, which are worth consideration.
Yeah, well said. I feel like we've hit on a lot of the subtopics,
Yeah, I
if
agree.
you will, that I had in mind. So this is good. Just the natural flow progression of us talking through it. I do think it's worth talking about the quote-unquote glide path confusion of how the target date funds might reduce equity exposure too early or too late for some investors, which we kind of talked about earlier. The fees, transparency, and control, I think, is another one worth mentioning.
Yeah.
And maybe there's a smarter way to plan besides using target date funds, and we can talk about what that would look like. If you're like, hey, okay, Tim and Tyler, they seem like they might be fans of target date funds, but also maybe not. If you're not fans of it, what would you do instead? And maybe we can talk about that briefly.
Yeah, no, those all sound like smart. Let's hit those three bullets separately. So
Yeah.
let's start with the glide path confusion.
Yeah.
I know it seems like I may have communicated some of the confusion that could occur from a glide path aspect if you don't understand the basic concept of what a target date fund is, and you don't realize that you're supposed to choose a date that's consistent with your retirement date or your anticipated retirement date, then you may choose incorrectly. What if you look at it and just don't understand that, and you think, oh, it's 2025, I'll go in the 2025 fund, and you just don't understand that you're supposed to pick a date that's geared towards your retirement, not geared towards where you are right now, or when you think you might change jobs. That's not the purpose. You're going to end up in a totally different allocation than what you probably should be or would have otherwise chosen. And the other element of that glide path, I think, is as you're on the glide path, as you get closer to that retirement date, that mix of stocks and bonds is what we're talking about. And it can easily be more aggressive or more conservative than you want to be. And that, I think, is really the most important thing.
Yeah.
Your desire from a risk standpoint, your desire from how much you want to have in stocks versus bonds, it should really drive your portfolio. And if you're not paying attention to that, both from a logic standpoint and from an emotional standpoint, in terms of how you feel about your investments, then you may find that you're quite disparate. As far as the actual allocation during that glide path, it may be very different than the allocation you would otherwise choose. And the more different it is, clearly the less advantageous the target date fund would be for you.
Yeah. I think two different investors in the same fund can have very different needs at retirement or whatever target date they're trying to achieve. Mm-hmm. One person might really need, that's all their life savings in that fund. And then another person, they might have so many other resources to rely on, and their asset allocation between stocks and bonds might differ very greatly from the other investor. So,
well, one thing that just dawned on me: all target date funds are not the same. If you get into a 2040 fund with one fund company versus a 2040 target date fund with another fund company,
very true.
Every fund company has their own interpretation of what that portfolio should look like, and their own interpretation of what that glide path looks like as far as adjustments as you get closer. And consequently, I'm thinking back now, I remember some of our clients that we had that were with a particular company when they introduced target date funds. We analyzed the target date funds with that particular company, and those target date funds were actually really quite good. And so we felt very good about those target date funds, and for many of our clients, we recommended that they use those as the best allocation option available in their limited investment profile that they had available in their retirement account. So it was actually a recommendation of target date funds that we were giving clients in those retirement accounts. There are many other situations where we've looked at the target date funds and they are not at all consistent with what we would recommend. And The client needed to choose retirement timeframes that were different than their actual intended retirement in order to get the allocation more in line with where they wanted to be. And that's another way we've had to adjust the recommendation to accommodate the right mix based on how askew those particular allocations were in those target date funds. So it is a big topic that maybe a lot of people just brush over, especially because it's meant to be this easy button option. And the fact that you clicked on this podcast and said, I want to know a little bit more about that, says maybe you picked the easy button option already, or maybe you're thinking about it and you're wondering if there's anything else under the hood that you need to really give consideration to before you make that choice. And hopefully this podcast has given you a little bit more clarity on what's under the hood.
Yep. Well said. What about fees, transparency, control? What about those things?
Yeah.
Where does your mind go?
I think that the fees, mutual funds, including target date funds, if you look at the prospectus, you'll see an overall expense ratio, and it's combined reflective of the management fee and any other kinds of fees that might be associated with that mutual fund. And if you look at those that expense ratio, you'll get a sense of what the percentage fees are on a target date fund. Because a target date fund is aggregated from other multiple sub-mutual funds inside of it, they're trying to do the best guess at mixing together what that mix of all those other fund fees might be like. If they change the allocation among stocks and bonds, then immediately, because the fees might be different in some of those sub-funds, the overall fee that you might actually be paying might change. It's going to be moving fairly regularly, probably within a range based on how that mix is going. It's not to say that that's a large differential that you're going to experience, but everybody's got their own feelings about the significance of fees, and even a couple of percentage point, or not percentage point, but let's say hundredths of percentage point moves can have significant real dollar implications, especially if you have a large amount of money in these kinds of accounts. In general, I would say a target date fund for people under $100,000 in their invested portfolio looking for an easy button is probably not a bad thing. And when you get above 250, you probably want to be given some pretty serious consideration of how you're allocated. And anywhere between 100 and 250 is worth giving some consideration to that mix. I'm not saying don't do a target date fund if you have over 100, but know what you're investing in pretty well if you're doing that. And frankly, even if you're under 100, you're going to be better served by paying attention to how those accounts work. So that's fees.
Yeah.
There was something else that you said, though, in the bottom of that.
Transparency and control.
Yeah, control. Yeah.
Control. You don't have as much control over what they're using inside the fund.
Yeah, no control.
Yeah, you have no control. And also transparency. I think sometimes, depending on the target date funds I have seen, there's less transparency with seeing all the nuts and bolts inside the fund. Yeah, when you have different layers, as you do when you have sub-managers inside the fund, because they're using other funds to build the fund, essentially.
It's a fund-to-funds approach.
It's a fund-to-funds approach. Yeah, there's
it.
Layers. So there's layers to the fees, trying to find the true fees, because there's layers to it. There's layers to the transparency of all the different investments inside there. And, they have a compliance responsibility to make all that available. These are all monitored, publicly traded things. However, to the average investor, that stuff might be harder to find unless you know what you're looking for and where to look for it. So
That's good.
yeah.
Well said.
Is there a smarter way to save and plan, Tim?
Well, yeah. I think fundamentally, the more money you have, the more significant little differences are. A little difference in fees, a little difference in rate of return, a little difference in risk tolerance, allocation, makes a big difference in your retirement plan and in your portfolio, because it's all magnified by the amount of money you have. If you have a small account, those differences are not as big of a deal. If you have a very large account, those differences are a huge deal, because everything is like a snowball. In your early years, if you're starting at the top of a hill and you're rolling a snowball down the hill, the snowball's pretty small, and as you get older, that snowball gets bigger and bigger and bigger at the bottom of the hill as it accumulates more snow. That's the way it is with your investments for retirement. And if you're investing well and you're growing the snowball and getting a good rate of return, the impact of fees, losses in the market performance, or incorrect portfolio construction in your later years as you're close to retirement can have a massive impact, and I would take a massive bite out of that snowball. And nuts. You know, it's funny. I think about the financial loss that we had in 2008 when the financial crisis hit. Stock market dropped 50% or so, and then in 2022 we saw the stock market drop. You know, it's closer to 15-20%. I would say in 2022. I think it was high teens.
Yeah.
So like 18 and a half or something that the S&P might have finished down in 2022. But people who had retirement money, let's say they were like 60 in 2007, experienced a massive financial hit when that 2008 financial crisis hit, and they saw that big snowball get cut in half with a 50% drop in the market. Versus, you know, people who at that time were younger and just building up their snowball. They were, you know, it wasn't as scary for them. The snowball was much smaller, so taking away 50% of it short term, and you know, wasn't as big of a deal. In fact, they were able to continue to accumulate more, even though it was scary for everybody. I mean, a 50% drop's not fun. Now, those same people that were younger in 2008 are now older in 2022. So that little 20% drop or 18%-ish drop in the stock market, because the snowball was so much larger for those people who accumulated wealth, that was probably way scarier for them than the 50% drop back in 2008. Even though the market dropped much, much less at an 18% decline, because the snowball was so big, it was much scarier for the people who had accumulated the wealth at that time. So just to give you one example of the difference that perspective makes and your own timing and where you're at in your own part of the plan.
Yeah. Yep. It's like rate of return. It's like if you got a $10 investment, you get 100% rate of return, your 10 goes to 20. It's not very exciting. So I didn't make a lot of money.
That's right.
If you got a $100,000 portfolio and goes up 100%, which if that's the case, good on you, goes to 200. That's very exciting and also very scary at the same time. But same rate of return, same performance, different sizes of it.
That's right.
Different size of the snowball, as Tim was talking about. Cool.
That's good. Well, why don't we bring it home with the Just the Answer?
Let's bring it home.
And wrap it up. So Just the Answer, let's have you restate the question.
Would love to.
Yeah.
Are target date funds helping or hurting your retirement plan?
Okay, and the quick Just the Answer is, it depends, which is the answer for many of our Just the Answers.
It is.
Is it helping you or hurting you? I would say it's helping you if the allocation happens to coincidentally be similar to the way you would have otherwise chosen the allocation, and you don't want to spend a lot of time thinking about your own allocation. You want an easy button option, and you might be able to have diversification on a much smaller portfolio. So if you're young, you choose a retirement time frame that's pretty far out, and you're investing a small amount of money, building up maybe less than $100,000, probably helping you more than hurting you. If you have over $100,000 in your account, or you're older, or you've already retired, and you're not paying attention to how your portfolio is really allocated, there's, I would say, a better probability that it's hurting you versus helping you, because odds are it's not allocated exactly the way you would want to be, and it might be even a little bit more expensive than you need to be in order to get the mix that you really want. If you can make more and pay less, that's better, and that's probably available to you if you take a look at some alternative choices in your retirement years versus continuing to use a target date fund.
I like it nice and tight. I think the name of the game is understand what you're doing, or give your best foot forward to try to understand it. Because if you understand it and you're happy with the target date funds, good on you.
Spot on.
If you don't understand it and then you're kicking yourself later because you were in a target date fund that was way too conservative for your risk tolerance or way too aggressive for your risk tolerance, that's on you. You could call us though. We can always look at it with you though.
That's right. That's what we do. And they call us by calling 503-579-1000. That is our phone number.
That is it.
I'm sure we'll reiterate it to you again later, but we have a little bit more fun ahead of us now.
Yes, we do.
Yeah. Where are we
got
going?
some trivia, man.
All right. What do you get?
Okay. Also, I was going to do a trivia question based on when the first target date fund went into existence. I thought that was kind of boring, so
it is kind of boring.
I pivoted away from that. But anyways,
Okay.
do you know what year?
I would have
first
guessed
target date
around
fund?
2000 or so would have been my guess, but
I think it was 1994.
94. Wow.
Yeah.
Okay, got it.
I believe so. I
Okay.
think it was Wells Fargo.
Wow, interesting. Well,
Initiative.
it's a cool idea. It's a convenient button. It certainly created more diversification for a lot of people that would have otherwise just gone into a savings account in the side of their retirement account, not made any kind of interest because they were too afraid, or they just would have gone into some other kind of a default option that might have not have been as well diversified. So
Correct.
It was a good solution to create some diversification that is a little bit more aligned with people's retirement for those who are not spending any time thinking about their allocation at all.
Yep. Yeah. Another one of the trivia questions, not the main trivia question, that was an option, was when was the Roth IRA created and who signed the legislation for it.
Well, I was a senator with the last name of Roth that I thought created it, that's where the Roth IRA came from.
Yeah, it was.
And I think it was pretty close to the year that I started in the business. I got in the business in 1997. I think it was either 97, 98, or 99 when the Roth IRA came out. I'll go with 97.
It was 97.
Oh, okay.
Yeah,
97.
97.
Same year I started in the business.
Yeah.
So.
Okay, real trivia question.
Okay.
All right.
That was all fake trivia.
That was just
Now we're going with real trivia.
Didn't exist. Which fruit was the first to be eaten on the moon?
Ooh. How would you... I guess you could eat the fruit in the spaceship on the moon, but you couldn't really eat the fruit in your space suit on the moon.
Probably not.
I think. I mean,
I don't know really how space.
you'd have to leave like an apple in your helmet and then just like kind of bob around for it while you're there because you can't reach your hand in there and move it around. So I would say that would have had to. Yes, okay. So on the moon, technically, probably inside your space capsule.
Fair.
Let's see.
You want some choices?
Orange, banana. I'm just gonna guess. What would hold its
Apollo
own
11.
variable? I can't imagine. A banana would have probably rotted by the time it got out there.
You're not eating banana.
Let's go with I think an orange would probably hang in there for a while. I'm just gonna go with an orange.
I mean, it's fair. It was one of my choices. It was canned peaches.
Of course, canned. Well,
Yeah.
that makes a lot.
Canned
more sense.
peaches, everyone.
Canned
First
of
fruit
peaches.
eaten on the moon.
Peaches for free. Peaches for me. All right, that's good.
So,
Well, canned peaches. Stumped the nerd today. I did not know canned peaches were the first fruit eaten on the moon.
Now you do.
If you did, you are brilliant, clearly. If you didn't, you're still brilliant because we love you anyway.
That's right.
Thank you for
That's
joining
right.
us on Clear Money Talk. I think we can bring it home today. Any final words?
No, I just keep on working hard, keep on doing the right things, and keep on moving forward.
Yeah, and we're here to help. If you need help with your money, that's what we do.
Yep.
Give us a call, 503-579-1000, or you can check us out on the internet, clearfp.com. Thanks for joining us on Clear Money Talk.
See you next time.
Tim Clairmont and Tyler Andrews are investment advisor representatives offering securities and advisory services through Cetere Wealth Services, LLC, member FINRA SIPC. Advisory services offered through Cetere Investment Advisors, LLC, a registered investment advisor. Cetere is under separate ownership from any other named entity. The views depicted in this material are for information purposes only and are not necessarily those of Cetere Wealth Services, LLC. They should not be considered specific advice or recommendations for any individual. Cetere Wealth Services, LLC exclusively provides investment products and services through its representatives. Although Cetere does not provide tax or legal advice or supervise tax, accounting, or legal services, Cetere representatives may offer these services through their independent, outside business. This information is not intended as tax or legal advice. All investing involves risk, including the possible loss of principal. There is no assurance that any investment strategy will be successful. Examples referenced are hypothetical only and do not represent the actual performance of any particular investments. Converting from a traditional IRA to a Roth IRA is a taxable event. A Roth IRA offers tax-free withdrawals on taxable contributions. To qualify for the tax-free and penalty-free withdrawal or earnings, a Roth IRA must be in place for at least 5 tax years, and the distribution must take place after age 59 and a half or due to death, disability, or a first-time home purchase up to a $10,000 lifetime maximum. Depending on state law, Roth IRA distributions may be subject to state taxes. Distributions from traditional IRAs and employer-sponsored retirement plans are taxed as ordinary income and, if taken prior to reaching age 59 and a half, may be subject to an additional 10% IRS tax penalty. Investors should consider the investment objectives, risks and charges, and expenses of mutual funds and ETFs carefully before investing. The prospectus, which contains this and other information about the funds and ETFs, can be obtained directly from the company or from your financial professional. The prospectus should be read carefully before investing or sending money. A diversified portfolio does not assure a profit or protect against loss in a declining market. Dollar cost averaging will not guarantee a profit or protect you from loss, but may reduce your average cost per share in a fluctuating market. Investors cannot invest directly in indexes. The performance of any index is not indicative of the performance of any investment and does not take into account the effects of inflation and the fees and expenses associated with investing. Although it is possible to have guaranteed income for life with a fixed annuity, there is no assurance that this income will keep up with inflation. There is a surrender charge imposed generally during the first 5 to 7 years or during the rate guarantee period. There is a surrender charge imposed generally during the first 5 to 7 years that you own the contract. Withdrawals prior to age 59 and a half may result in a 10% IRS tax penalty in addition to any ordinary income tax. The guarantee of the annuity is backed by the financial strength of the underlying insurance company. Investment subaccount values will fluctuate with changes in market conditions. An investment in a variable annuity involves investment risk, including possible loss of principal. Variable annuities annuities are designed for long-term investing. The contract, when redeemed, may be worth more or less than the total amount invested. Variable annuities are subject to insurance-related charges, including mortality and expense charges, administrative fees, and the expenses associated with the underlying subaccounts. Investors should consider the investment objectives, risks, and charges and expenses of the variable annuity carefully before investing. The prospectus contains this and other information about the variable annuity. Contact Clear Financial Partners at info@clearfp.com or 503-579-1000 to obtain a prospectus, which should be read carefully before investing or sending money. The cost and availability of life insurance depend on factors such as age, health, and the type and amount of insurance purchased. Before implementing a strategy involving life insurance, it would be prudent to make sure that you are insurable by having the policy approved. As with most financial decisions, there are expenses associated with the purchase of life insurance. Policies commonly have mortality and expense charges. In addition, if a policy is surrendered prematurely, there may be surrender charges and income tax implications. The target date of a target date fund may be a useful starting point in selecting a fund, but investors should not rely solely on the date when choosing a fund or deciding to remain invested in one. Investors should consider funds' asset allocation over the whole life of the fund. Often, target date funds invest in other mutual funds, and fees may be charged by both the target date fund and the underlying mutual funds. The principal value of these funds is not guaranteed at any time, including at the target date. Clear Financial Partners is located at 15573 Bangy Road, Suite 100, Lake Oswego, Oregon 97035. For more information, please call us at 503-579-1000.